The modern world runs on a quiet addiction. It's not oil, not technology, not even money itself, but debt. Every nation, every company, every family now relies on borrowed promises to survive another day. The numbers have grown so large they no longer feel real. Global debt has surpassed $300 trillion, 3 times the world's entire annual economic output. Yet markets still cheer, politicians still spend, and central banks still print, as if this structure could expand forever. Debt was meant to be a tool, a bridge to future prosperity. Instead, it has become the foundation of the entire global system. Every dollar in existence is born as debt and must be repaid with interest that can only come from even more borrowing. The economy no longer grows by creating value, it grows by creating credit. But this addiction didn't start overnight. It began centuries ago, when the world's most powerful institutions discovered that control over debt meant control over nations themselves. From the first bonds of empires to today's digital currencies, debt has quietly become the bloodstream of power. The question now is no longer how much we owe, but whether we can ever stop owing at all. Long before modern finance, debt was already shaping civilization. In the clay tablets of Mesopotamia, 5,000 years ago, scribes etched the earliest records of credit. Farmers borrowed grain from temples during bad harvests, promising to repay after the next one. Debt wasn't evil then, it was survival. But even in those primitive ledgers lay a truth that would echo for millennia. Whoever controls the debt, controls the debtor. In ancient kingdoms, debt became a political weapon. Rulers would forgive the debts of peasants to buy loyalty, or enslave them when they could not repay. Empires like Rome built vast financial systems to fund conquests, borrowing from merchants and the wealthy elite. Interest became the invisible chain binding soldiers, traders, and citizens to a system larger than themselves. When debts piled too high, empires fell, not from enemies, but from insolvency. The Middle Ages turned debt into theology. The Church declared usury, lending money with interest, a sin. But as trade flourished, morality gave way to necessity. Italian bankers from Venice and Florence invented double-entry bookkeeping, turning debt into an instrument of expansion. Kings funded wars not with taxes, but with credit from these early financiers. The Medici family, for example, built their dynasty not through gold, but through paper promises. By the 17th century, the world entered a new age, the age of organized national debt. In 1694, the Bank of England was created not to store gold, but to lend to the government. For the first time, a nation's power could be multiplied by borrowing against its future. War, trade, and empire became functions of credit. Debt had transformed from a private transaction into the backbone of statecraft. And the modern economy was born in that moment. From London's financial district, the blueprint spread across Europe and eventually to America. Governments realized that debt could fund not only armies, but entire societies. The more a country borrowed, the more it could spend, and the more it spent, the more it appeared to grow. But hidden beneath this newfound prosperity was a dangerous dependency. Debt was no longer a temporary measure. It had become the engine itself. From empires to banks, from kings to citizens, everyone began living in tomorrow's money. And as history would soon reveal, once a system learns to live on debt, it can never truly live without it. The 20th century began with a promise that modern industry and innovation would lift humanity into endless prosperity. But beneath the smoke of factories and the hum of new machines, a new kind of empire was rising. It was not built on land or armies, but on credit. When World War I erupted, nations discovered the true power of debt. Governments could not afford to fight a total war with existing gold reserves, so they borrowed massively. Bonds were sold to citizens as patriotic investments. Buy the war, save the world, the slogans read. But after victory came a harsh truth. The debts remained long after the peace treaties were signed. To pay them, countries printed more money. The result was inflation, the silent tax that eroded savings and trust. In Germany, a wheelbarrow of marks could barely buy a loaf of bread. Yet rather than retreat from debt, the world doubled down. Debt had become a tool too powerful to abandon. The Great Depression in 1929 exposed the fragility of this system. When credit collapsed, so did the illusion of growth. Factories closed, banks failed, and millions were left without work. In response, governments once again turned to debt, this time not for war, but for rescue. Franklin D. Roosevelt's New Deal was financed by borrowing on a scale never seen before in peacetime. For the first time, public debt was rebranded as a moral duty, a way to stimulate the economy. Then came World War II, and with it the ultimate test of the debt machine. The United States financed its war effort through an unprecedented expansion of credit. By 1945, the U.S. national debt had ballooned from $40 billion to nearly $300 billion. Yet instead of collapsing, the post-war economy boomed. Why? Because debt was no longer a burden. It had become the bloodstream of modern capitalism. In 1944, at the Bretton Woods Conference, a new financial order was written. The dollar, backed by gold, became the anchor of global trade. Central banks coordinated to stabilize currencies, and debt flowed freely across borders. For the next 2 decades, the system seemed unshakable. But under the surface, something was changing. Productivity was no longer the main driver of growth. Borrowing was. Corporations expanded on credit. Consumers bought homes, cars, and appliances with loans. Governments ran deficits to maintain prosperity. The global economy had crossed a line. It no longer needed savings to grow. It only needed debt. And in that shift, the seeds of permanent addiction were planted. By the late 20th century, debt had evolved from a tool of governments into a personal lifestyle. What began as state borrowing for wars and reconstruction became a private phenomenon. Credit was no longer seen as a burden. It was marketed as liberation. Owning more, buying more, and living beyond one's means became the symbols of success. The transformation began quietly. In the 1950s, the first credit cards appeared, a simple way for middle-class Americans to buy now and pay later. What seemed like convenience was the beginning of a cultural revolution. Debt was democratized, no longer confined to banks or nations. The average citizen could now participate in the same system that had once financed empires. Then came the 1970s, the decade that changed everything. In 1971, President Richard Nixon ended the gold standard, breaking the final link between money and tangible value. For the first time in history, global currencies were backed not by gold, but by confidence. Money could be created at will, and debt no longer needed a physical limit. Central banks became the architects of endless liquidity. The 1980s and 1990s completed the transformation. Deregulation opened the floodgates of global finance. Wall Street learned how to turn debt into tradable assets, mortgages, bonds, derivatives, slicing and selling obligations as if they were products. The concept of leverage became the new religion. The higher the risk, the greater the reward. Credit became identity. To have debt was to be trusted. To live without it was to be invisible. A good credit score replaced savings as the new mark of financial health. Debt had become so normalized that few questioned its purpose anymore. It was no longer a means to an end, but the end itself, the mechanism that kept the modern economy spinning. Meanwhile, governments discovered that consumer debt was their greatest ally. Every borrowed dollar meant another sale, another job, another vote. Entire economies began to depend on households staying indebted. The illusion of growth was maintained by people buying homes they couldn't afford, and companies expanding on borrowed capital. By the dawn of the new millennium, the addiction was complete. The global economy had engineered a cycle where growth required debt, and debt required growth. Any pause in borrowing meant crisis. Central banks learned this the hard way in 2008 when the world's financial system nearly collapsed under the weight of its own credit creation. But instead of detoxing, the world chose a new fix: lower rates, more printing, more debt. The addiction had become irreversible. By the 21st century, debt was no longer just a tool of finance, it had become the architecture of modern civilization. Every institution, from governments to corporations to households, was built on the assumption that tomorrow would always pay for today. Growth, prosperity, and even social stability depended on one simple truth: credit must keep expanding. After the 2008 financial crisis, central banks promised reform, but instead of dismantling the fragile structure, they reinforced it. Interest rates were slashed to zero. Trillions in new money were created under the polite name of quantitative easing. The world's largest economies were effectively kept alive on life support, an endless infusion of liquidity. The line between recovery and illusion began to blur. Stock markets soared even as real wages stagnated. Asset prices inflated while debt levels hit historic highs. Governments justified every new borrowing as stimulus, every new bailout as stability. The pandemic of 2020 only deepened the dependence. Lockdowns froze economies, but central banks responded by printing more money than ever before. In the United States alone, over $5 trillion was injected into the system in less than 2 years. For a moment, it worked. Markets recovered, home prices surged, and consumers spent again. But underneath the euphoria, the addiction tightened its grip. The money that once represented real productivity now represented only future obligation. Every dollar printed was another claim on tomorrow's labor, another promise that could never truly be kept. Debt had replaced reality. Politicians no longer debated how to balance budgets, but how much more to borrow. Corporations no longer sought profit, but leverage. Even individuals measured success not by ownership, but by access, how much credit they could command. And as rates began to rise again in the 2020s, the illusion started to fracture. Nations faced record debt servicing costs. Households struggled under mortgages and student loans. Emerging markets buckled under the weight of dollar-denominated debt. The system could not function without cheap money, yet cheap money was the very thing eroding its foundation. The global economy had reached a paradox. It could neither afford to borrow nor afford to stop. Debt was no longer the symptom of crisis, it was the system itself. And like any addiction, withdrawal was no longer an option. Every addiction eventually reaches a point where the next dose no longer satisfies. It merely prevents collapse. That is where the global economy stands today. Governments, Corporations and citizens have become so entangled in credit that the entire structure survives only by expanding its own illusion. Debt has stopped creating growth. It now simply sustains the appearance of it. In 2025, global debt surpassed $300 trillion, a figure so vast it defies comprehension. But what's more alarming is not the number itself, but what it represents, a future that has already been spent. Every dollar of debt is a claim on income that doesn't yet exist. Humanity is living in a time borrowed from the future, trading tomorrow's potential for today's comfort. Central banks know this. Every time the system wobbles, they intervene, cutting rates, printing money, or buying bonds. It's no longer policy, it's reflex, because they understand what most citizens do not. If the debt stops growing, the economy stops breathing. The machine can only run forward, even if it's running toward a cliff. But cracks are spreading. Rising interest rates threaten to bankrupt nations. Consumers buried under credit cards and mortgages can no longer borrow their way to prosperity. Pension systems are strained, currencies are volatile, and inequality has reached levels unseen since before the Great Depression. The rich own the assets inflated by debt. The rest owe the liabilities that sustain them. Some call for a reset, a debt jubilee, a digital currency system, a great restructuring of the global order. But resets are not painless. They are the financial equivalent of withdrawal. To truly end the addiction would mean accepting collapse, lower living standards, political unrest, and a generation forced to rebuild on real value instead of borrowed illusion. History tells us this much. No empire, no system, and no civilization built on debt has ever escaped it without consequence. From Rome to Weimar, from the British Empire to modern America, each believed it could manage the cycle, until the cycle managed them. The tragedy of the modern world is not that we are in debt, but that we no longer remember what life without it looks like. Debt has become our collective oxygen, invisible, vital, and dangerous in excess. And as the next crisis brews beneath the surface, one truth remains. The world isn't just addicted to debt, it is defined by it.